Hi, I'm Tom, host of Keep the Change. The autumn budget has landed and there's a lot to take in. Headlines focus on the big political noise, but many of you want something simpler. You want to know what the changes mean for your wealth, your plans, and the choices that you make next. So I'm here with Kristian, financial advisor at Octopus Money and Money Marketing's Young Advisor of the Year, to help you digest it. What's changed, what stayed the same, and what matters most for people with more complex assets, higher incomes, or long-term goals that need careful planning. We'll keep it clear and focused so you can understand the points that could shape your financial decisions over the months ahead. Before we get started, a quick reminder that any references made in this discussion to specific financial amounts, activities, tax rules, or potential returns are illustrative examples only. Investments in equities carries risks and potential growth does not guarantee returns. We encourage all listeners to seek tailored advice, which will enable them to evaluate their financial situation against their long-term goals and investment risk appetite. Kristian, let's get into the excitement of the autumn budget. It doesn't get better than this. It's kind of like Christmas for financial advisors, I feel like.
Yeah, or Halloween maybe.
Maybe Halloween. Really good point. I would love to actually start with the things that have not changed. Because I think everything we tend to read about the budget is all about those shiny headlines and what's different compared to last year. But there is an awful lot that actually has not changed. What comes to your mind about the big things that haven't changed?
Yeah, absolutely. So I think I have this discussion a lot with clients when we get to budgets. I think particularly with the Labour government, we've gone, I guess, in a slightly different tax world now where tax rises are increasingly on the agenda, and what that generally creates is a bit of nervousness and uncertainty ahead of any announcement, and people wanting to do something to try and protect themselves against, we see it in all the newspapers, Rachel Reeves considering this is going to happen, this, and I think the big ones this time round were some sort of change to the amount you can get out of your pension tax-free, and what we saw, sort of in the wider market, there's a lot of people crystallising their pensions, taking out the lump sum, and then HMRC very quickly announced you will not be able to unwind this transaction. Yeah. If the budget doesn't announce it, and lo and behold, they didn't change anything, and now a lot of people have probably missed out on quite a lot of growth on that money. It could have been a lot more valuable to them later. So it kind of goes back to that core message of, let's see what the rules are and make a plan around the rules, rather than trying to plan around speculation, which we'll just get wrong one way or the other. I think another one is pension allowance, say the £60,000 or up to £60,000 a year you can pay in. That was left untouched. I think we've discussed previously, it seems every budget and every time it comes around, there's even none of the Conservatives, I think they were thinking, do we change the higher rate and additional rate tax reliefs? And still they stay. So again, not doing anything kind of preemptively on that front. I think income tax more or less stayed the same. She sort of bended her rules maybe. Working people, so increasing the amount on rental income, but leaving employment income alone. There is obviously the caveat where salary sacrifice will be less attractive come 2029, but we've got quite a long time till anything happens there. So lots of time to sort of plan and readjust any sort of pension savings. And then the inheritance tax, there was thinking of changing the 7-year rule, and that's still staying as is. And I think the other big ones probably were some sort of, like we saw last time around, an immediate shift on capital gains tax. She, I guess, has left it alone this time, had a stab at it last time, so left it as it is. There is a small caveat to that, which we'll probably cover later. And probably finally, national insurance on rent or partnerships. And again, didn't come through, although you are paying slightly more tax on your property income now, so through the income tax mechanism. But yeah, so I think the big scary stuff didn't come to fruition. What we've probably seen in summary is a budget of tinkering around the edges and sort of announcing stuff and delaying when it kicks in. So I don't think there's any sort of major overnight stuff that people really need to be too worried about.
Yeah, I think this will be a really interesting budget to remember in future years, especially with all the speculation that ran up to it. Because even watching it live yesterday, there were two things kind of ringing really clearly in my head in your voice, which was, first of all, the speculation. We have no idea if these things are going to be announced or confirmed. And as you've just explained, so many of them were not. And so again, when we think about the budget next year, when inevitably there is this list of things that are being speculated on, let's remember that this year no changes were made, and hopefully we're in a good planning position as a result. And the other thing that I've also heard you mention many times is that even when changes are introduced, generally they're brought into the future, giving you a little bit of time to kind of either make plans or adjust plans. Very rarely do they come in where they're applied from tomorrow, which again, hopefully this budget really, really does confirm.
Yeah, exactly. There's a few tiny things in there where it's an immediate change. But yeah, as we've seen, generally most of it's way off. Actually, I'd say maybe this is a bit of an exceptional budget, how most of the significant changes are actually towards the end of the Parliament, which then probably raises the question, how, if those changes come through, will be in an election year, will they just get immediately reversed by the next lot, whoever get in? So
exactly.
Yeah, I think.
Yeah, it's really, really tough. And I mean, before we go on to talking about some of the things that are changing or have been confirmed, one thing I have been reflecting on is actually how difficult of a task it is to be a Chancellor. Because I was kind of sitting there thinking, what would I do in Rachel Reeves' situation? Because it's very easy as listeners or even as advisors to think, what is the impact on people's wallets ultimately? And think that's the only thing that should be dictating decisions. When in reality, I think what the government are having to constantly consider with any of these changes that come in are absolutely our wallets and also our votes to a degree. Are we going to keep voting in a Labour Party in the future? But the other big entity they're having to please are things like bond markets, who ultimately are making a judgment on how financially sound the UK government is. And then the other kind of entity that Rachel Reeves is having to please are businesses. They want to be producing things for the economy and keeping people employed, so you need to keep them sweet, as well as her colleagues in the Labour Party as well. So any single decision that is made, you're having to appease these four very different kind of parties, and it is a bit of a tightrope walk. And just before we started recording this, we started thinking or discussing, what else could have been done? What are the major changes?
Yeah, I suppose the economy situation probably isn't fantastic at the moment. Mm-hmm. And I think, as you touched on there with the bond market, what we're probably seeing come home to roost is this huge expanse in national debt. Mm-hmm. And you are now, as a Chancellor or the government, very reliant on the bond market playing ball. We had super low rates, the bond market sort of cooperated with that, and then famously, I suppose, Liz Truss. That's probably, in recent times, you could say that the downfall, the bond market basically got rid of a politician, very quickly. And the bond, UK bond market's still sort of slightly suffering from that. It's been one of the worst asset classes to be invested in for the last 3 years or so. So I think that might be more and more a factor as she still hasn't balanced the books. We're still increasing debt. And every year this cycle goes on, we probably will see that, no matter what you say in your manifesto or parliamentary party, you've got the City of London, kind of lurking in the background.
Exactly.
And if they say no, then we saw what happened with Liz Truss, and we'll probably see a similar sort of cycle.
No. One of the big announcements that has been confirmed yesterday is the freezing of tax allowances and tax bans through to 2031. So originally came in from the Conservative Party in 2021 or so, and now it's been confirmed that they will be frozen all the way through to 2031. And this conjures up words like fiscal drag. I will challenge you to explain why this is a bad thing in the simplest way possible.
Yeah, so the freezing of the allowances, we've seen this date basically just get increasingly nudged out. I think it was set at 2028 and now it's 2031. And basically what happens is over time, when the government raises the minimum wage, you sort of see wages across the board rising, inflation, everything, so people's incomes do sort of slowly adjust. Maybe they don't keep up exactly, but basically more and more people are falling into higher rate tax, or more and more people are falling into additional rate tax. And it's what they sometimes dub as a stealth tax. Mm-hmm. So the government can claim, we're not raising your taxes, in their headline figure, but really they are just subtly. And I think it's something like, is it a higher earning household will be about £4,000 worse off by 2031? Yeah. Something like that. So yeah, it does have a huge impact on people's wallets, and hopefully that was relatively succinct.
I think that was great. I understood it, which shows it was simple enough. And do you feel like there is a particular part of society or a particular earner that is hit hardest by this, or really is it just a shared pain across the whole country?
Yeah, I don't know to say. I'd probably say it's what are sometimes dubbed as the Henrys, like high earning, not rich yet.
Yes.
So maybe that kind of slightly younger demographic, maybe struggling with the explosion we've seen in property prices to get onto the property ladder. They've got a really decent income, but most of it is, being eroded away through tax. And I guess it's really hard in those foundational years to build up your asset base, and then have assets that grow over time, and you kind of generate wealth through that. So that's probably, I would say, the people who are most squeezed.
Yeah.
And if your income is basically solely through employment, you can do things like pension and save for your future. But if you need a property or whatever else it may be more immediately in your life, it is quite a hard balance to strike.
Yeah, I totally agree, and I think it will be arguably most visible for those people that are right on the edges of bands, who can kind of expect maybe an inflationary pay rise over the next year or so, or maybe a well-earned promotion. You will see yourself all of a sudden potentially tripping into that next band and seeing a different rate of tax. And the only thing I would reiterate, it can sometimes catch me off guard how many people think that the income tax system is that as soon as you trip into that next band, everything is charged at that rate. Just keep in mind it is a marginal system. So it's only that amount that goes into that extra band that is charged more. Don't feel like you should reject a pay rise because you're going to go into a 40% band, which crazily I've heard so many people think that that's the way that it works. But hey, that's for the education episode. One of the other big tax changes, which is relatively new, is this concept of a mansion tax. Same challenge. Could you summarise what this mansion tax is in the simplest way?
Yeah, so basically, if you've got a house that's worth more than £2 million, the government's going to add at least £2,500 extra council tax. Now they're going to, I can't remember what the exact word they called it,
some surcharge. Yeah.
More tax basically, and there'll be a sort of sliding scale up to 5 million, and if you have a property that's worth 5 million or more, you'll pay 7,500 in tax. So probably the impact of this is those who are asset risk cash poor, which probably is the older demographic, bought a house, it's ballooned, like particularly where we are in London, ballooned in value, but maybe you don't have the liquid assets that go with that, or you've got some sort of pension income and that supports your lifestyle, so you don't have an extra 7.5 grand a year lying around. And it's those people, I suppose, that will have to weigh up, do you downsize the house, some sort of decision there. I think they're going to revalue all properties. Is it in band D, E, F? Do you also F? I can't remember the council tax banding. So they'll go through that revaluation process, and then I guess you'll sort of find out where you stand. But I guess most people generally have a rough idea of what the house is worth. Yeah.
And I've kind of been waiting for a bit of information or clarity on what that revaluation process might look like, because often one of the kind of facts or features of council tax in the UK is that depending on where you are in the country, they use a totally different date of valuation on the property. And I think, without bad mouthing any particular region, I think Westminster is one of the worst.
I think it basically pays more or less no council tax relative to property value.
Exactly, because they're using property values from something like the 1980s or 1990s, which is crazy, relative to other parts of the country that are using more updated values. So that's actually something I was really pleased to hear, because it feels like that's the best way of levelling the playing field slightly, at least when it comes to council tax.
Yeah, I think council is because all the councils do it slightly differently. They all have the slightly different rates. I think Westminster also benefits from a lot of their revenues from businesses. Right. So they don't think they lower it much on property compared to a traditional council where it's mainly properties. I think she maybe could have had another go at equalising that really across the board. It does seem, I think the north is disproportionately paying a lot more than the south in council tax, and people in probably moderate value homes are paying broadly the same as those in red. So this is probably a step she sees in the right direction on that. But I feel council tax is one of the things that just needs to be relooked at and almost start again. It seems so out of date and out of whack. Yeah, it's very, very old school. And then rounding off the section on tax, it would be wrong of us to miss the slight changes to some of the tax rates that are applied, especially to, I was kind of surprised how clear it was being described by the government as non-earned income. So I think it is Rachel Reeves' Labour Party basically saying, look, if you haven't earned, in inverted commas, that money by an income or employment, we are going to tax you at a higher rate. So
What rates have changed, Kristian?
Yeah, so I'm sure maybe some people who run a business and pay themselves dividends may disagree with
Exactly.
Rachel Reeves' definition, but that's not for us to comment on. So really, the main one is dividend taxes are going to go up. They're sort of basic and higher rate. They're going to add 2% on there. They're actually slightly strangely leaving the additional rate alone. So I guess if you're in those two buckets, you're going to be dragged up slightly. They're going to add 2% onto property income. So or the income tax you pay on the profits, it would now be 22% rather than 20, and 42 rather than 40, and so on. So slight increase in tax there, and then savings as well. They're going to tax more. So and people might say, I paid tax on the income. I was diligent. I put it away, and now I'm going to get taxed on the slight bit of interest. So, is that earned income? Is that not? You have had to probably work for it at some point. But anyway, it's one of those.
Exactly.
Who decides, and it's Rachel Reeves at the moment, so they're the ones that are going up.
And when you have your advisor hat on, and you're sitting in front of customers who are in this position where dividend taxes are going up, savings taxes are going up, rental income taxes are going up, what kind of planning options come to mind that might be able to either help people keep more of their money or at least alleviate tax burdens?
Yeah, so I think they're all slightly different in what kind of options you have. Property is probably the hardest to do something. Every time you transact on property, you're going to be faced with a tax bill. So let's say you've got a buy-to-let. If you want to dispose of it, you're looking at capital gains tax. It's not a cheap thing. You've got estate agents. It's not a cheap and easy thing to get out of or into. So your options are probably slightly more limited there. Probably trying to offset your tax bill with some other mechanism is what you want to be exploring. Things like dividends taxes, and taxing on your interest. So we've seen this. We'll probably touch on the slight change to the cash ISAs, but shielding your savings where you can, and then dividends. Trying to use vehicles that are more tax favourable. So it might be pension, ISAs, maybe an offshore investment bond, something like that, where you're not subject to the tax regime on your investment portfolio. Obviously, they will have slightly different nuances, and they're going to have to fit to someone's personal circumstances. But there are a few levers out there you can pull. And then, if you could look at your portfolio you're investing in, and maybe not, if you've got someone's invested in a very high dividend generating portfolio, you might change your strategy, to maybe a more growth based investment.
Nice, really, really interesting, and the perfect segue into changes to allowances and accounts, which is kind of how we've grouped them. Headline being the one you just mentioned. So cash ISAs all of a sudden have basically their own limit in terms of how much money can be put into them each year. So I'm sure many people are aware of this who are listening, but ISA allowance is £20,000 per year. Historically, as simple as that. You can make use of it as you wish, except for a lifetime ISA. But from the announcement yesterday, an allowance is coming in just for the cash ISA element of that. And what that means is you will only be allowed to put in up to £12,000 into a cash ISA each tax year. The whole reason that this change has come in is that I think Rachel Reeves and the government have been pretty honest, as well as Octopus Money to a degree, that we think investing should play a bigger role in people's lives. It has power and it has the ability to, not the guarantee, but the ability to deliver really good outcomes in the future. I hope that it will help more and more people to invest. And if anyone is listening who is on the edge, we are here to at least have a conversation and to see if we can help in any way. And important to note that actually if you or anybody is in the position where cash is the right vehicle for them to hold, and there are many, many circumstances where it is, you can still keep your savings in cash savings accounts. It doesn't have to be in a cash ISA, but you run the risk of starting to potentially be taxed on interest that you receive. And so just so that people are aware, if you are a basic rate taxpayer, you are allowed to receive £1,000 worth of interest tax-free every year. If you are a higher rate taxpayer, that's £500, and if you're an additional rate taxpayer, you don't get anything tax-free in terms of interest on your savings. So just worth being aware of all of that. Leading us on very nicely to arguably one that's probably got the most headlines, I think, which is all about salary sacrifice. Unless I'm reading in my own echo chamber, which is always a chance, and when I do bring up salary sacrifice with friends, they don't care too much. I get a little bit excited about these kind of things. Salary sacrifice historically has been an incredibly powerful planning tool for people to effectively shield their income, not only from income tax, but also from national insurance contributions. What are the changes that are coming in?
Yeah, so this is one of those changes that's going to come right at the back end of this Parliament, 2029. They're going to limit the amount you can salary sacrifice to £2,000 a year. You're basically going to be the national insurance uplift, that people got by doing salary sacrifice is not going to be on the cards as much anymore. Paying to a pension will still be massively beneficial, and you get all the income tax benefits. So that's been unchanged. It's just that extra sweetener of the national insurance that's being taken away. So a bit disappointing, I would say, particularly as generally across the country we have a massive underfunding of pension schemes and people aren't saving enough for their retirement. So tweaks like this probably don't help that, but it is still, the major tax perk of the income tax saving is still there, so it's definitely still worth doing. Yeah,
I think that's such an important one to reiterate, because I do worry that many people will see these headlines and actually think, I can only put £2,000 into a pension now, no matter what. And to reiterate what Kristian just explained, you still get the income tax benefits by paying into a pension. It is just the national insurance contribution benefit that you're no longer getting as a result of that limit. And so for a higher rate taxpayer, national insurance contributions tend to be paid at a rate of about 2% per year. The real pain with this change, I expect, will actually be borne by the employer, because employer national insurance contribution rates are charged at 15%, I think. And so that's a big additional cost if people continue to sacrifice amounts.
Yes, definitely.
Great. Up next, we're on to some of the other changes that have come out of the budget yesterday, which may not have kind of grabbed all of the headlines, but nonetheless are very, very important to note. Starting with one, which is actually one of the good news stories. We don't get many. Usually it's doom and gloom and, how do we change plans to handle the blow as best we can. But minimum wage is rising to £12.71 for, I think, over 21s from April next year, which is a big winning story.
It is, yeah. I mean, I imagine some businesses probably feeling the squeeze at the moment, maybe aren't welcoming it as much, but then equally a lot of people are feeling the cost of living pressure, so it'll be, welcome relief. I think it would have been nice if that had coupled with some sort of offset on employers' national insurance, to make sure that great, the wages are going up, but actually we're making loads of people redundant. You don't want that tonight. So that would have been the only nice thing to see, but good news for those who are going to receive that.
And another bit of good news, of course, is that the 2-child benefit cap has been removed. So something that has been in existence over the past number of years is if you're somebody who is on universal credit, you would only be able to claim benefits for up to 2 children. So if you were someone that had 3 or maybe 4, you would get the same amount of child benefit as if you had 2. And really good news, this has now been removed so that those with a larger number of children will receive additional benefits. And then finally, one that I actually don't know too well. I've not done masses of reading about this, but it's the changes to the electric car kind of road use charges coming in. How much do you know, Kristian? Don't worry if you don't know too much, because I haven't done much research on this one.
Yeah, I know the headline figures. So you're basically going to pay 3p per mile to drive an electric car nowadays, and £1.50. A penny basically for a plug-in hybrid. And what I think the government's trying to do is they incentivise massively electric vehicles, but now they're not getting as much fuel duty revenue, or they're not going to get as much road tax revenue because they give a lot of different breaks across the years. So it's the new version of fuel duty effectively. And I think the government said it's something like half the cost you would pay in fuel duty if you had a petrol car.
I see.
I think that was the numbers they came up with. So they need to get the revenue from somewhere.
Right.
And basically, I think now EVs are more widely adopted, they're going to start to roll back on the generous subsidies to encourage them.
I heard on the radio a very lively debate this morning about how kind of road tax, fuel duty should be applied. Lots of people saying that it should actually just be on the weight of the car. Like, forget if it's petrol, forget if it's electric.
That's the damage it does.
Yeah. Which I thought, okay, maybe that has legs, but
I don't know how they're going to track this as well. Maybe every time you do an MOT, when the mileage gets updated, but
No clue.
Bizarre.
Yeah, unless they rely on people to be honest, which, hey, fingers crossed, but I never know. Perfect. Some of the other important changes announced yesterday from Rachel Reeves, which arguably apply to certain sections of society which maybe aren't as kind of mass market or mainstream. And as a result, these are some kind of niche planning opportunities which Kristian, you know extremely well, me not so much. So I'm going to be in learning mode here. So run us through how things have changed with agricultural property relief.
So we had the budget last time where the Chancellor made all the different changes and generally cut things back on that front. Quite an unhappy farming population on the back of that. So what the Chancellor announced this time, it's kind of one of those small one-liners almost that probably got missed, is they're going to both business relief and agricultural property relief. You get £1 million per person. They're going to allow that allowance to be transferred to your surviving spouse.
Right.
So a bit like you have with the nil rate ban for inheritance tax, your spouse can inherit that. It's going to be the same. So probably a good news story there, really, and probably trying to appease a bit of the pressure they've had from the farming community. And also if you're a business owner, there'll be upside there. So maybe before where you were worried about passing shares directly to your children, it could go to your spouse now and transferred. But something probably to work through. But the pressure might be off if there's an elderly family member who owns something. There might be a bit more time now to think and plan out exactly the succession plan.
And am I overly simplifying this to say that what this is enabling people to do is not necessarily pay less, but it's giving them more time and passing on any potential liabilities onto kind of a second death?
Effectively, yeah. So your spouse would inherit inheritance tax-free anyway, and then you have the sort of combined weight of the allowances, and then you can sort of forward plan from that point. So that would be the kind of use case, I guess, more immediately.
Understood. And another, I guess, sneaky change, one that wasn't made much noise about, is this changes of taxation to employee ownership trusts as well. Yeah.
So basically a way for, I guess, employees to buy the business off the owners. Very kind of niche thing. You don't see it too often. But you used to get a really generous 100% capital gains tax relief. They've lowered it to 50, and that's one of these immediate changes. It's not many people that will be impacted by this. Those who are probably a bit miffed, but you still get a fairly decent rate of relief.
Interesting.
It was a bit of a strange one because the Chancellor, kind of after announcing that, said we're still very fond of co-ops and employee ownership. Those two things didn't quite seem to go hand in hand, but anyway, yeah.
Because it's another one of those which I think people listening or having seen some headlines, you could start to think, ooh, I own some shares in my employer. All of a sudden, am I going to be way worse off? But this is actually to do with quite a unique...
For most people, it won't be a huge difference.
Understood. And then a big one, which I think will absolutely impact the vast majority of many people who are listening to this podcast, is inheritance tax thresholds. They have also been confirmed to be frozen all the way through until 2031. I have no idea how long they've been frozen for, because I assume it's longer than the income tax plans.
I think it is. I think forever, it feels like almost. I can't remember when they last increased the nil rate ban, but a long time ago it feels like now. So just more of the same really. As asset prices grow over time, more and more people just fall into the bucket of having to pay inheritance tax. And it is one of those taxes that HMRC are collecting more and more from. So again, but I suppose inheritance tax is really an optional tax if you can plan properly ahead of time, passing assets on or doing the right things. They've left, as we mentioned, in the 7-year gifting rule alone, so you still have lots of opportunities to be able to plan around that, and try and get yourselves under the allowances will probably become harder, and particularly probably people in sizable value property. If you still want to live in the home, your options might be more limited, but we can definitely try and put some things in place.
A huge, can't help but feel like a huge planning opportunity there, with inheritance tax allowances not getting any bigger, but pensions being thrown into the calculation in the coming years. I wouldn't be surprised if the government's IHT receipts doubling, tripling into the future as a result of all of these things. But you're absolutely right. Key message here is, with planning, it can be reduced or sometimes avoided altogether. So definitely worthwhile getting your teeth into that. And then finally, changes to VCTs. Final challenge, can you explain a VCT in less than 30 seconds?
I'll try. So it stands for Venture Capital Trust. It's basically a very specialist type of investment product in really high is very high risk in smaller sort of startup UK businesses, and the key is it has to be UK businesses. So the government basically gives you a series of tax benefits to kind of fund growth and get that next generation of companies. So for example, if you invested £10,000, the government would give you £3,000 off your income tax bill, and then any dividends that product generates are tax-free in perpetuity, and you have to hold it for 5 years, and at the end, or whenever you decide to sell it past that 5-year point, you don't pay any capital gains tax. So really good product, has probably been the main driver for sort of, the growth, any kind of growth businesses in the UK. The market, particularly I think probably peaked 2021, but really sizable now, getting lots of investment into startup businesses in the UK. A bit disappointing to see the headline rate of relief cut. So it was 30% tax relief, it's now going to be 20, or it's a tax reducer technically, but anyway. We did have this happen before, so I think it was back in 2006, it was 40% upfront relief, and they cut it to 30.
Yeah.
When that happened, there was a 2/3 drop in the level of sort of investment into these kind of products. So hopefully, for those smaller startup companies, it's their main way to get capital. They don't see that. I do think one encouraging sign was the government was saying they're going to relook at the rules of what you can invest in.
Okay.
So the venture capital trust structure has very stringent criteria on what the underlying companies can be. They're looking to sort of expand that slightly and let you invest in slightly more established businesses.
Oh, nice. Okay.
So that might, the risk reward profile might make a bit more sense to people say, okay, I'm investing in something slightly less risk.
Yeah.
I'm getting slightly less tax benefits, but it still sort of makes sense.
Interesting.
It's one of those products that you really need to know. You need to know it thoroughly before going into it. So definitely that's something you would want to speak to us or another advisor about before entering into.
I had totally missed that. So that is really, really interesting because, the way that I had always talked about VCTs, or if anybody's come across things like EIS or Enterprise Investment Scheme, you really need to go into those with an element of knowing it could ultimately fail or lose value significantly. So if they are broadening the types of businesses that can make use of these as funding streams, that could actually be fair if the tax relief you're getting is slightly lower.
Exactly, yeah. So we'll see the finer detail on that and what actually happens, but it could be a fair trade-off. As I say, a little bit disappointing, the headline relief, but yeah.
Of course, everyone's situation is different, and it's best to have a chat with your advisor who understands your full situation before making any decisions. If today's changes have sparked questions about your own strategy, speak to your advisor and get the clarity that you need. Kristian, thanks for helping us make sense of it all.
Thanks, Tom.
Thank you.